Expense is a transaction that decreases net worth. If we leave aside other economic flows that are generally beyond the control of government, net worth can only be reduced if there is an expense. Note that the government or public sector unit can engage in many different types of spending transactions that are not expense. It can build a road, it can acquire equity on an exchange, or provide a loan to a corporation. It can repay its own debt. None of these spending transactions will be expense, because in all of these cases, net worth stays at the same level. Expense, however, always reduces net worth. This is why the budgetary control of expense is such an important element of government accountability processes. It's why analysts and the press critically evaluate expense programs. Of course, transactions in non-financial or financial assets should also be a concern for analysts. The fact that they have no impact on the level of net worth doesn't mean they are automatically reasonable or have no cost implications. All government spending must be financed in some way, and that financing often has long-term associated costs in the form of interest payments or other similar resource flows. Those interest payments will decrease net worth and so are a future expense for government. To recap, as a general principle, it is important to understand that expense has a negative impact on net worth, which is to say on the net position of the balance sheet. In contrast, transactions in non-financial or financial assets only affect the composition of the balance sheet, but not the level of net worth.